Hi everyone, welcome in. I'm Graham from GuruFocus. In today's video, we're going to look at Warren Buffett's 3 qualifiers for a wonderful company. We'll cover the 5 different kinds of competitive advantages or economic moats that can set up companies for success over long-term investment horizons, look at low capital expenditures that lead to high returns, and even hit on growth that value investors should be looking at. Stick around to the end of the video where we examine Buffett's top holding for these 3 features. If you haven't already, make sure to click that big red button down below to subscribe to the channel to stay up to date on all of our latest content. Throughout the decades, legendary investor Warren Buffett's teachings have largely been boiled down to one simple phrase. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. As I mentioned, wonderful companies can be boiled down into those with a strong and durable moat, low capex and high returns, and finally are growing. This first key point is that a company has a broad and durable competitive advantage, also known as an economic moat. These moats can be separated into 5 main categories to help determine what type of moat is at play for any given company. The first category is intangible assets. These are generally seen as some form of branding or patent that won't necessarily show up in a company's financials. A great example is Buffett's Coca-Cola holding. Coke is a worldwide brand that is recognizable anywhere on the planet. This is a massive advantage, as the customers will always recognize the brand and it's never going to be associated with anything else. The second category is customer switching costs, which means that a customer is likely to avoid the hassle of moving to a competing brand. An obvious example here is banks. Once a customer has set up a bank account, they will likely maintain that account for the rest of their life. To switch to another bank, they would have to go through the process of changing all of these things over, move their money, which would be a major pain, and generally speaking, most people aren't going to go through this process. Now, next up, we'll take a look at network effect style moats. These types of companies gain their advantage by establishing a wide network of support around the world. So with Visa and MasterCard, for example, they are accepted by the majority of vendors worldwide, and situations where they are not accepted are few and far between. As more companies accept the cards, more consumers will continue to get them, and the network continues to grow, which expands that moat. Now, we've made it to the moat of cost advantages here, which is relatively straightforward. If a company can lower costs for a product of equal value, the consumer will likely buy their product. They could buy other products from other brands, but generally speaking, they're going to pay a little bit higher price to get them, so they're going to stick with the one that gives them that cost advantage. And finally, we have the overall scale of the business as our 5th and final moat. Companies that are larger than others are able to offer their products to a larger audience and offer a greater convenience for customers. At the same time, their scale usually lends to cheaper production costs, which lowers the average cost for that customer, and if they can find it just down the street from them, they're likely to go with that business. The next thing you want to look for is a company that is asset light, which will generally lead to higher returns. These types of companies generally maintain a small footprint and don't require a lot of things to run their business. These types of things can be buildings, cars, machines, and any general infrastructure for the company to actually operate. Now, generally, the lower the company's required assets and expenditures required to maintain them, the higher returns that a company is going to see. So, software companies, for example, here require a few computers and programmers to operate, which costs very little money just to get the ball rolling. This means that they are paying less to actually generate a profit and therefore return more money for their efforts. This also makes it easier to expand the business, and the actual risk involved in that expansion is pretty low. These types of companies generally maintain much lower levels of debt, as they aren't required to make big purchases to find success. Now, to give some concrete examples here, let's go ahead and take a look at Microsoft and GM. Looking at Microsoft's return on invested capital, you can see the number remains relatively high throughout most of its history. It has been slowly declining, but that's over the last 20 years, but this number has been generally in excess of 20 to 30%. Now, if we switch gears and look over at GM here, it's pretty much the exact opposite story. GM has barely been eking out single-digit return on invested capital numbers here, and it's been on a little bit of a rise, but nothing too significant here over the last 20 years. And finally, Buffett was looking for companies with growth. Keep in mind here that there really are no separations between growth and value investing, as growth is what drives up value in many companies. As a company grows, generally prices will rise alongside of it, investors will find higher returns, and value investors can benefit greatly if a company's stock price does not follow that growing value. Here they may actually find themselves lucky enough to average into an investment at a low price with value on the rise, so the company is growing that value and the stock price stays reasonably low for a decent period of time, giving them some good returns if it bumps up in the future. So how do you actually go about finding if a business is a wonderful company? One of the most straightforward ways to find out if a company has a moat is to look at its profit margin. Companies that have a large moat will usually maintain an above average or even growing profit margin throughout their history. Now, just for context here, the average operating margin for companies is usually right around 10%. So now let's go ahead and put these ideas into practice. We'll look at Buffett's biggest holding, Apple. Apple is seeing an operating margin sit pretty steady right around 30%, or almost 3 times the average, and actually saw a decent jump at the end of 2021 to 33%. Looking at the overall trend lines for Apple's operating margin, we actually see that it has been on the rise on a quarterly basis, and that growth has actually been increasing in speed on an annual basis if we look at the last 20 years. Now, without a doubt, Apple has several moats going on that give it great competitive advantages. First off, the company is another global brand that is known by almost every consumer out there. Apple products are dominant in the tech space and are used by millions of people. A second and less obvious moat comes from a network effect that Apple has established in the last several years. iMessage is one of the most widely used messaging systems that operates exclusively on Apple's devices. This system offers encrypted, high-speed messaging, and many people have actually found themselves avoiding the dreaded green bubbles that come from Android devices. This is developed especially in younger generations to the point that consumers will purchase an Apple product to stay within the same network as their peers. Now, looking to Apple's return on invested capital, we see that it is well above average over the last 20 years, and it's actually heading back towards the higher levels seen in the last decade. The company is generating strong cash flows and is easily able to support business costs here. And finally, taking a peek at its growth, revenue has skyrocketed over the last 20 years, EBITDA shows a similar story with strong gains, and earnings per share is actually hitting all-time highs. To wrap everything up with a quick summary, Warren Buffett's wonderful companies have 3 key qualifiers that investors need to look for. First, they should have a broad and durable competitive advantage, aka a moat. These allow the company to operate without worry of a competitor taking their success. Second, the company should have a low capex requirement and a high return on invested capital. This lets them make money and even expand their business without worrying about the need to take on debt. And finally, the company should have profitable growth going on. This builds value for the business and shareholders alike. Now, keep in mind, these types of companies are the ideal investment in Buffett's eyes and are incredibly hard to find. Once you find one of these companies, your next step is to determine what is a fair price, but keep in mind that fair price will be subjective to each individual investor. As these types of investments are going to build value throughout their lifetime, the ideal holding period is decades, if not forever. For those of you that want to invest in the footsteps of a legend like Buffett, we encourage you to come over to GuruFocus.com and give a free 7-day trial a go. Come try out some of our screeners that we have set up and see what wonderful companies you can find. As always though, make sure to do your own research or consult a registered investment advisor before making any investment decisions. If you haven't already, please click that big red button down below to subscribe to our channel, and make sure to drop a like today if you enjoyed the video. Comment below if you think we missed anything, and tell us about any wonderful companies that you've found and invested in throughout your lifetime. That's it for today, and we'll see you on the next one.